Hello, good evening. Thank you to everyone for making time tonight to join us. My name is Kevin Cumbus, co-founding partner here at TUSK. We're going to be spending this evening looking at 2020 and the year that was and give you guys some insights from the M&A market that we enjoyed and also look at 2021 and what we can expect in the years to come. I will tell you, we emerged from COVID stronger than ever before, more knowledgeable than ever before, and more excited about the M&A markets than we were even back at the end of 2019. So we've got a lot of information to cover, a little bit of housekeeping before we get started. On your screen there, you should see a Q&A panel. Feel free to tap in any questions that you may have on your mind. We will certainly answer them in the days to come. We won't be doing any live fire Q&A. We've just got too much to cover today, but we'll respond to each of you individually. So with that, we'll go ahead and get started. Before we dig in on all the details, I think it's helpful if we just give you a brief overview of TUSK, who we are and what we do. So I'm Kevin Cumbus, President, Co-founder, and Managing Director of the Mergers and Acquisitions Group. For those of you who don't know me, my experience is 10 years in finance and investment banking, followed by, I guess now it's 16 years on the business side of dentistry. Love the space, am connected to it through my father, who's a dentist, and cannot imagine a career anywhere else. I'm also joined tonight by Ryan Mingus. Ryan, can you introduce yourself?
Sure. Thanks again, everybody, for joining. Ryan Mingus, Director of Mergers and Acquisitions at TUSK Partners. Been with the firm for about a year now, a year today. And prior to that, I worked at Align Technology, basically serving as an in-house management consultant to advising them on their DSO strategy. Before that, management consulting in the healthcare hospital space. And before that in business development roles throughout the healthcare space. So feel that my time here at TUSK is definitely marrying all my backgrounds between business development and mergers and acquisitions in the healthcare space. So happy to be here.
Thanks for being here, Ryan. I also want to take just a minute to give you an overview of TUSK and be a numbers guy. Sometimes it's easier just to do this with numbers. So 8 team members in total. Over the course of our collective experience, we've worked on over 900 dental transactions. We cover 100% of all specialties nationwide. Collectively, we've got 80 years of dental industry experience. We closed over $100 million of transactions in 2020 and have over $180 million under letter of intent today. We are signing up new clients each and every day, and I think one of the big reasons is that our lifetime average transaction multiple is 7 times, and it actually went up this year. So really great team, a lot of experience, and proud of the work that we've all accomplished here this year and every year. I also want to share with you that the team here on the M&A side of the business is growing, scaling up to meet demand. You've met Ryan and you know me, but we also have Alex on our team and George, who's an analyst who really serves both the M&A side of the business and the consulting side. So 4 dedicated team members that work on just about every transaction, so we can deliver custom solutions to each one of our clients and really provide that white glove service. So one thing we've learned over this most recent year is that TUSK does things differently. We have been told this by attorneys. We have been told this by the buy side, business development guys on the buy side, leadership inside of the buy side. And I think it starts really kind of who we are and how we were raised inside of the businesses that brought us here. My background is investment banking, accounting, economics, finance. Alex's as well, along with Ryan's, and I think what we do that separates us is we start at a very, very granular level when we think about valuation and dig deep into the numbers, and as a result of that, provide really rich, robust virtual data rooms for the buyers as they are looking to make decisions quickly. The net result of this is a real trust from the buyers, a trust from our clients that we've got the numbers right, and ultimately it increases speed to close and allows us to have collaborative conversations around valuation that ultimately drive up value for all. We are regularly told from buyers, oh, if TUSK is on the other side, I know it's going to cost us a little bit more, but at least we know we can trust the numbers. And that's something that we all take great pride in. We also recognize that every deal is different, and we take the time to understand your business almost as well as you do. And we really want to take that time, because if you're working with us, you're selling your life's work. And that is not something that is lost on us. And we want to take the time and attention to detail to put you in the best light, to garner the most interest and drive up the value to the best of our ability. So let's move on to a little bit more about the market now and review the year. So let's now dig into the 2020 M&A year in review. So 2020 was, let's just be candid, it was a real challenging year. We started in January with more deals than we've ever had in market, more deals in pipeline than we've ever had, more phone calls from the market from entrepreneurs like yourself that were looking to sell their businesses and partner with DSOs. It was absolutely frenetic. It felt as though the buy side, their appetite for deals knew no bounds. Every deal that we took to market was oversubscribed. The valuation multiples were hitting new peaks each and every month. We did not foresee the shutdown coming at all. Ryan, you were here for you just started. You'd come in. Now you've got 12 months, a pretty incredible 12 months underneath your belt. What were your impressions as you started here at TUSK in Q1?
Yeah, so it felt like a whirlwind. Kevin's right. We were signing up a new client every single week. In the process, I think in January we took like 6 deals to market. So juggling things in market, all of the buyers, all of that feverish interest that Kevin mentioned, alongside onboarding new clients. It was a whirlwind and extremely positive, and I really knew nothing else. But looking back on it, it was a really fun and exciting time for the firm for sure.
Yeah, it was, all that wind in the sails was propelling us towards an incredible year. And then COVID-19 shuts down the dental industry, and it also shut down the buy side. I mean, we saw, our clients calling us, asking for advice. The consulting arm of our business did a remarkable job helping both M&A clients and consulting clients shut their business down, make hard decisions on whether to furlough team members or keep them on, help them source the PPE necessary to continue to see patients. It was a terrifying time from a health perspective, and it was hard on each and every one of our clients. No one went unscathed from this. We saw large DSOs, multi-state, private equity-backed, furlough whole business development teams, and we saw buyers completely disappear. This timing couldn't have been worse given what was in the market at that point. So we decided to use that time to talk to buyers. We spent days on the phone with every buyer that we could speak with, the guys that we were doing transactions with and some that we just knew from years of experience in the space, and trying to glean from them how their leadership was looking at the shutdown, the COVID impact to not just the short-term business of dentistry, but the long view in the business of dentistry. And over the course of the second quarter, 3 things started to happen in the buyer pool. So we had all these deals under a letter of intent, and the buyers took 3 positions. Position 1 was, look, we love the core business we're going after, your client. We've got the capital to close. We're going to close this deal, and let's just keep diligence rolling. We saw this primarily in the specialty space. Specialty space was a little less impacted than the GP space was. We saw endodontics and oral surgery be able to keep their doors open for emergency services. And if you've ever had a root canal, if you've ever needed a root canal, I'm sure you know that that is a necessary service when needed. So really those two specialties performed surprisingly well during the period, and the deals that we had under letter of intent, especially in those specialties, marched forward each and every day. The buyer characteristic of deals like that, they were typically newer private equity-backed DSOs with ready access to capital, strong relationships with their lenders, and didn't have a lot of legacy businesses on there. So their core business was relatively young, and the businesses that they had acquired up to that point were performing quite nicely. The second group that began to appear in the buy side was the wait and see group. Now these were normally legacy DSOs that were on their second or third private equity sponsor. They have hundreds of locations nationwide, and frankly I think the concern was twofold. One, they needed to make sure that their core business had appropriately shut down and was prepared for the rebound. They had their own operational matters that they needed to tend to in order to ensure that they would not just have a business at the end of this, but have a business that was flourishing and heading in the right direction coming out of COVID. The second pressure that they were feeling was from their lenders. I don't know of a DSO that stayed within covenant the entire time that COVID hit. For those of you who aren't as familiar with that vocab word, when you get a loan from a bank, you sign a list of covenants that you will not breach, and many times these are ratios that are connected to your debt service. Well, if your business shuts down for a couple of months and you don't have revenue but you have debt service, in all likelihood you probably breached your covenants. Now, lenders, to their credit, were helpful here. They didn't want to own the DSOs. They really wanted to see the DSOs survive and thrive and come out of this, and banks don't want to own those businesses. So, smart bankers worked with the leadership to ensure that there were pathways to get them back into covenant, but it was a little bit of a scary time there. So put yourself in a lender's shoes now for a minute. The lender who has millions of dollars of credit extended to the DSO is now asked by that same DSO to issue additional debt to buy their acquisition pipeline, to actually consummate the transactions that we are representing. Lenders weren't keen on doing that. And because of that, they really had to take a wait and see position, not because they didn't want to close the transaction, they absolutely did, but they weren't given the capital needed to close the transaction. And we're going to spend a little bit of time talking about what happened as a result of that, but I think we'll put a cap on the wait and see guys for now. The final group was the duck and cover group. Now, this was a very small handful of DSOs, but there were a group that decided that they needed to look after themselves. We were joking around the office that they probably were reading that children's classic, Chicken Little, and they believed that the sky was falling. They thought this was it. They had so much fear that they were paralyzed. Those groups really showed to me their true colors and who they are. And I will tell you, unless there are major changes inside of those organizations, it's highly unlikely we'll be doing transactions with those folks going forward. Ron, I've hit the highlights there in Q2. What other things were you seeing as the quarter unfolded?
Yeah, for Q2 on the buy side, I think there was still a lot of interest in the things that we had taken to market in Q1 and trying to find pathways to get deals closed. So I think that's when the collaboration really began from between ourselves and the buy side in order to get these deals done from those buyer type one who wants to get the deal closed, and even the wait and see folks that had something so far along in the process that they had to continue and find a way to get it closed. So I think that's when the collaboration started, and then that's really when we started to see the reemergence of the earnout.
Yeah, that's a good point. So the earnout was something that, even 2 years ago, we would see infrequently in transactions, in letters of intent to purchase our clients. But in the last 12 months, let's say for full year 2019, the earnout really went the way of the dodo bird. We didn't see it anymore. I mean, earnouts were initially used, we believe, to align interest and ensure that the doctor whose practice you're buying would be incented to continue to grow the business post-sale. DSOs got pretty smart here in recent years and began offering equity to the dentists who are selling and partnering with them. And what they've recognized is that equity is a very powerful tool of alignment. And that tool of alignment really allowed deal makers to step away from earnouts. Now, they came back strong in this year. When we first saw them, we saw earnouts as large as 20% of the total enterprise value initially proposed in Q2 and early Q3.
Yeah, and it was really a mechanism because our clients wanted 2019 valuation. Well, I could hold firm on 2019 valuation as a buyer, but I need to protect myself. So the mechanism that they used was an earnout whereby 20%, 10%, 5%, whatever it is of the total enterprise value would be set off to the side at the closing table. And then some period of time would have to be realized and some performance would have to be met during that time period for that earnout to be released. So it allowed our clients a pathway to get a pre-COVID valuation, bet on themselves a little bit, but and maybe not take the deal that they had in mind when they went to market, but certainly could close with a lot of confidence that they were going to be able to achieve a 2019 valuation, albeit with 10 to 20% of it hanging out in the form of an earnout.
Yeah, this is where the deals got renegotiated almost.
Sure.
Right? So there was a lot of appetite for our clients to get a deal done. Keep in mind that there was a presidential election looming. There was uncertainty in the markets, uncertainty in the debt capital markets. Nobody could quite figure out what was going on in the stock market. And it felt like I need shelter from the storm. Mm-hmm. So, our clients definitely wanted to do transactions, but they didn't want to give it away.
Right.
No one thought that this was a fire sale. This was a health issue. It was not a systemic issue with the economy. And we knew once we get through this, everything should be fine. Right. So we had big appetite to actually get a deal done, but we on the buy side, they couldn't get the leverage that they needed to support at least the full valuation terms, deal terms of the letter of intent. So it was really about trying to build equitable transactions that met both buyers and sellers' needs in Q3.
Yeah, and I think I used the term before, it was collaborative. And, we were able to get favorable terms for our clients in an effort to reduce that earnout based on performance between the time that they signed that letter of intent and the time that the quality of earnings and the closing actually happened. So if there's a 60-day, 90-day period of time in that, well, that business is recovering every single month. We've got new data to support it. So if they started with the letter of intent at a 20% earnout, ideally by the time we got to close, we could reduce that amount to a level that was in line with the recovery of the business.
Yeah, and did an excellent job in doing that, and in large part because our clients were managing their businesses so effectively. Right. Not everybody was in that position, but those who were gave us a much higher likelihood of seeing the earnout go down and in some cases even go away completely. Mm-hmm. In Q3 as well, it became clear that not all the buyers were as forthcoming with us as they could have been early on, or maybe they didn't know, or it felt like some true colors really started to show in that third quarter when some buyers just owned the situation.
Right.
and said, look, we've done everything in our power to try to get this deal closed. Unfortunately, we're not going to be able to chin to that bar. And those were not fun conversations to have. They were not easy conversations to have. We've spent, months, in some cases a year, working with our clients to get them to the finish line. We're through the Q of E, and ultimately the buyer can't get the capital to close. I will say, in the deals that occurred, in situations where that occurred to our clients, we were able to find buyers for them within a short number of months at valuations higher than they received in 2019. So all's well that ends well there.
Sure.
It did create stress and strain, but you got to kind of sometimes just play the hand you're dealt. But the big takeaway for me is the lenders really flex their muscle in this environment, and in many ways they were the ones calling the shots.
Yeah, and I will add that come Q3, we saw some of those wait and see folks, firm up on their position.
Yeah.
So we had some new buyers coming back to the market. We had a couple it was clear where they stood. So there was a little bit of settling in period in Q3.
It's also the quarter where we started closing deals.
Sure.
Started closing deals and started seeing new sellers come to us and say, look, I've weathered COVID. I'm back up and running. I'm doing better this month in 2020 than I was doing this same month in 2019. But I would like to consider a partnership and look for an opportunity to partner. So, Q3 was like the turning of the ship in many ways for us.
Right.
All right, so we get through that. In Q4, we have a presidential election that has been decided, and we have more certainty around the future. We started talking internally about around October that end of year was going to be bananas. It was going to be late nights, most weekends, and sometimes you set the expectation that you hope you never hit. But it was 100-hour work weeks and a lot of energy to get these deals closed. Ron, I know you worked extremely hard. Everyone in our team did, and we did it all for our clients to make sure that they got what they wanted and what they deserved for their businesses. The last day of the year, we closed 6 transactions back to back to back in 24 hours. That's a record for us. I think if you could just annualize that one day, that would be a successful year.
Yeah, not too shabby of a year.
No, not too bad.
And we were wanting to make sure that we met those deadlines by end of year because of that presidential election. We wanted to make sure that we solidified and locked in the tax rates for these deals because these people, our clients, had been some of them we had in market for 6-7 months. Others just came to us in market in Q3 and we got them turned around really quickly. So there's a pretty wide range of folks in terms of where they were at, but they all had the same goal, which is I want to lock in this current tax rate, and who knows, it's possible that they could make something retroactive back to Jan 1, 2021 with respect to tax changes. So we wanted to give our clients every opportunity to capitalize on the favorable tax structure.
Yeah, there was so much noise in the market. There's so much fear in the market about what could happen in the event we had a Democratic White House and coupled with the House and Senate. And didn't know the answer to that question until the Georgia election results were finally in and tallied. One thing I found fascinating over this year was the different derivations of EBITDA. Leading up to this point, we had all been focused on the trailing 12-month EBITDA, and then in Q2 we started hearing something called a pre-COVID EBITDA, where we looked back almost like, let's call it February 2020, and said let's just do a trailing 12 as of then, because the dental business in March, April, May was chaotic.
Right.
We had the PPP loans coming in. We had everybody treating their team differently. Some kept them all on, some didn't. Ortho was getting payments through payment plans, but they didn't have any costs. Right, so their EBITDA margin was like 1,000%, which is like, it's mathematically impossible. So this is where the pre-COVID EBITDA came in. And then as the months wore on into Q3 and the beginning of Q4, a new term arose called COVID-adjusted EBITDA, where we'd take the months in 2020 that were impacted by COVID and we'd pull them out of the 2020 P&L and drop in those same months from 2019. And all of a sudden, in the fourth quarter, the fourth one appeared, right? So now we're doing run rate EBITDA, meaning just the let's call it 3 months post-COVID. And then finally, we're almost to a point now where we're just going to be looking at TTM again, because the noise of COVID is about to fall off the income statement.
Yeah, I think that's definitely indicative of the specialty businesses. It was really easy. You know, we just took an oral surgery group to market early Q1 this year, and we were able to use the trailing 12-month EBITDA through October.
Yep.
No adjustment made. So, you know, the oral surgery, the ortho, those groups are, you know, likely going to shake out, at least our clients, about where they were last year. Some are even going to be up or slightly down, but the GP is where I felt like we saw the COVID adjusted EBITDA the most.
Yeah, I'd agree with that. Well, look, it was a incredible ride this whole year, and I'm elated and I'm proud of the work we did as a team to get our clients what they want to get their deals closed, and I want to share some of that success with everybody on the webinar here on the next slide. So here you'll see some select group practice transitions. This list does not include the solo transactions that we did, and I want to direct your attention. Let me teach the slide real quickly and then highlight a couple of things for you. On the left-hand side, you'll see the status of these transactions closed, the ones that are under letter of intent scheduled to close in the next couple of weeks and months, what type of practice the group is, the number of locations, the number of doctors, TTM revenue, TTM EBITDA, and the resulting enterprise value at which we close the transaction or have it under letter of intent. And the multiple, in the green box, you'll see the multiples. Enterprise value is a multiple of EBITDA, and then enterprise value is a percentage of revenue. We know enterprise value as a percentage of revenue is an erroneous number, but it matters to some people, so we're going to show it. Two areas to focus. On average, that first blue band at the bottom, our average group practice multiple is 7.82 times, or 200% of revenue, and in the specialty space, it's about 8.6 times, or 250, let's call it, percentage of revenue. We break this out a little further on the next slide. You mind if I go ahead and advance?
Yeah, go ahead.
Okay, so here the graph reads exactly the same, but we're going to look at GP up top, followed by oral surgery, then orthodontics, and then pediatric dentistry. So these are 21 transactions. I think it is absolutely worth noting that of these transactions, 16 of them are going to unique buyers. And that is super important for everyone to know, because we are going wide on every one of the deals that we take on, and every one of the mandates that we receive from our clients. We go wide each and every time because the buyers shapeshift over time. And the buyer that paid the highest multiple last week is likely not the buyer that's going to pay the highest multiple for a very similar transaction next week. And really that's the joy of our work, is finding out who that's going to be and how our client's opportunity best fits the market's desire.
Yeah, we spend a lot of time sourcing new buyers. You know, we take a lot of phone calls and exchange a lot of emails that really do nothing to move a deal forward that we currently have. But we want to make sure that we understand all of these opportunities, and we notate who they are, what they're looking for, what their target acquisition profile looks like, and you know, we catalog that away for a day when we have somebody that fits that like a glove. So that's where that 16 different buyer types came from.
Yeah, it's a lot of conversations throughout the day. I go home and my kids are like, "What did you do all day today?" And I just say, I'm just very grateful I have unlimited minutes on my cell phone. There's a lot of conversations that we have that are seeds that are sown, that really don't pay the bills immediately, but come back and benefit our clients in the long run. Two more takeaways from this slide. The group comparables, the group transactions traded about 2 turns higher than solo transactions, irrespective of specialty, and that specialty group practices traded about 1 turn higher than GP groups. It's that specialty piece that's really interesting to me now, because we're seeing so much more demand for specialty groups and solo businesses than we saw 2 years ago. I mean, it's like nothing I've ever seen. New businesses being created. We're playing a role in a lot of those. In endo, oral surgery, orthodontic, pediatric, pedo-ortho. I mean, it's everywhere.
Yeah, the specialty space, I think, especially for buyers coming out of COVID, if they had committed to including specialty in a traditionally GP-centric DSO, they've really turned up the volume on that. And now a creation of many new specialty-specific DSOs.
All right, well, let's kind of see if we can put a bow on this one and give the audience our takeaways and lessons learned from 2020. So every Friday I hop on a call with our analytics team, and we talk about lessons learned. There's so much that happens each and every day, each and every week. I find it extremely helpful at minimum on a weekly basis to look back and share and ask others, what have they learned? There was so much going on this year. There were so many lessons that I learned, that I'm sure Ryan learned, but we wanted to share with you kind of our top list here. Number one is that the buying landscape has changed, and it has changed for some time to come. Buyers who were in the space months ago, some of them have disappeared. There are DSOs that have filed for bankruptcy. There are DSOs that are on the block. There are some DSOs that cannot get leverage from their lender to make acquisitions. And at the same time, there are new private equity groups that are calling us and wanting to be a part of this rapidly consolidating industry. There are DSOs that have great relationship with their lender, and they had very conservative balance sheets and leverage that are now poised to make acquisitions in markets that they otherwise hadn't thought about doing. So the buying landscape, it was always shape-shifting in 19, but now more than ever, it's a real stark contrast compared to what we saw at the end of last year. Item 2 is that no 2 DSOs are the same. We have said this early and often at TUSK. If you know one DSO, you know one DSO. Every one of them is different, not just financially or culturally, but the leadership and the relationships they have with their PE sponsor and the relationships they have with their lender. It was very obvious to me over the early months of COVID where the excellent leaders were inside of the DSO community. They were communicating regularly with their doctors, regularly with us, regularly with their management teams, and we were hearing that. There were some great DSOs out there who were publishing information about how they were managing the shutdowns and how they were managing the team that they wanted everyone in the DSO community to have. It's leadership like that really helped the industry as a whole, and it's really one of the main reasons I enjoy the space that we're in, because we're all out looking after one another. But that wasn't the way everybody handled the situation. So, now armed with the information that Ryan and I have, we're able to make better connections for our clients to DSOs that we can speak from a depth of experience with that we didn't frankly have before. I mean, leadership and management has a way of really defining itself during crucible moments like we saw during COVID. And now armed with this, we can make stronger and better connections for our clients. We've referenced the point number 3 a little earlier, but there is newfound interest in the specialty space. We've talked about how well they performed during COVID. I'm sure everyone on the call is well aware of specialty-specific DSOs that have emerged, or and that's like specialty exclusively for oral surgery or endodontics or orthodontics. But then there's also groups that are looking at just clusters of specialty, and they abound as well. Yeah, I always thought the specialists kind of viewed themselves on the outside looking in, and now they're able to participate in all this wealth creation. They were a little slower to engage it, but now that they're here, they really know, and our clients in particularly know, that they can have their hand on the wheel of a ship as they're guiding and directing it, not just in their region, but in the nation.
Yeah, I think that is what I hear most from our clients or soon-to-be clients when they're considering exploring a market, when we're demystifying and educating them on what this world actually is, what's on this other side. And there are some historical misconceptions or perceptions that exist, and we address those head on. And it's nice to be able to point to a couple that we personally started with an inaugural transaction to create a specialty-specific DSO that we can put these folks in touch with our previous clients and let them tell the story for themselves.
Yeah, absolutely. There is more opportunity if you are a specialist or the owner of a specialty group than there ever has been. Right. And with more demand means higher valuation multiples. So it's a great space to be active in. Two more points here. Newly formed groups are moving faster. A newly formed group doesn't have, say, 20 businesses that they've already affiliated with, 20 locations they've already affiliated with. They're not suffering from drag of their core business, but what they're really doing is leveraging everyone that they know in the space to try to find the best and the brightest businesses to partner with. They have great standing with their lender, but we are seeing them put a lot more equity into transactions than ever before. I mean, we're seeing 10, 20, 30, $100 million deals where the lion's share is equity, and the leverage is 2.5 times on transactions. So they're really putting their money where their mouth is, and what they're the traditional PE, what we have seen PE do in the past is basically do an LBO and put a sliver of equity in. Now the private equity deals we're seeing are much more equity heavy than they are debt heavy. Mm-hmm. And I love to see deals like that because that truly is a partnership.
Right.
Final thing I'll say about 2020, and this is hard to say. So 2020 was a challenging year for many of us, me included. Lost dear friends to COVID-19, had businesses and colleagues' businesses really challenged by this. There are countless people that lost jobs. There are countless people who are and will continue to be unemployed for months and unfortunately maybe even years to come. But I actually believe COVID-19 was a good thing for our industry. There were simply too many duct tape DSOs. There were too many folks out there who believed they could slap together 20 locations and flip them and make a profit and not have to do any of the hard work. We at TUSK have been saying this for a long time. To build a true platform business is not easy. And there is a lot of risk that you take on when you decide to head down this journey. Thankfully, we've gotten in front of a lot of people and they've heard that message. But for those that didn't or foolishly went on even armed with the information, they were kind of exposed during COVID.
Certainly.
If they didn't have the cultural connective tissue to get through this, or systems and operations that were strong enough to withstand it, COVID shone a very bright light in a dark place in their organization, and it caused splinters and rifts, and it created a lot of pain for people. And I don't wish pain on anyone, but I do think a thinning of the herd was appropriate at where we are today. So the businesses that did survive, clearly they are in the elite group. And the buyers today, I think, are much better and better positioned to make acquisitions than they were in the past.
And I think all the newcomers into the space coming out of COVID, or they they got attracted to the space because of the way that dental performed during COVID.
Yep.
I think people are going to be looking at these businesses in a different light, so to speak.
Hey, that's a great segue. Let's kind of move on from the past,
Right.
and talk about the future.
Let's get out of here.
Yeah, I think we're all ready to see 2020 in the rearview mirror,
Right.
and move on to the year we are in now. So let's talk about the forecast for 2021, the year we are in right now. Ryan, do you want to kind of give them an overview of what you're seeing and what you believe the year will look like?
Yeah, so just things that are hangovers from 2020. Our Q1, we're going to close, what, $180+ million of enterprise value. So it's going to be, off to a rockin' start for sure. And then new groups that are calling us that are interested in the space because they saw that dental is COVID resistant and specialty dentistry is COVID proof. There's clearly going to be a lot of buyers interested in this, and we're already seeing it. We're also starting to get a lot of phone calls from some folks that are, ready to move forward with going to market. They want to take advantage of the favorable tax environment that we're in right now. So we do feel that 2021 is going to be busier than 2020. I think that a lot of that also has to do with the fact that DSOs have a lot of ground to make up for, right? They've got to acquire certain levels of EBITDA before they can themselves go to market. And 2020 wasn't the year that they probably thought they were going to have. So in 2021, they're going to be making up for lost ground.
Quick side note on this, just every year, Ryan, we go out and we survey the top 20, 30 DSOs, and they're kind enough to share with us the information about how many practices they acquired in the previous year. I know that we're still in the process of gathering that information, but I can't wait to share it with our listeners here to show that material decline. I mean, we heard in Q4 from buyers saying, send us anything, we'll overpay. And that's them trying to hit a number.
Right.
And to be armed with that information, we're working with our clients, that's powerful.
Absolutely. So kind of touching on overpaying, or let's talk about valuations. What we're seeing of the things that were set to close in Q1, what was able to close in 2020, is we feel that valuations will be at or around 2019 levels, which is great to hear for all of the folks that didn't have a chance to take their business to market in 2020. We do feel that they will still be at those 2019 levels, which is great for all of us. And obviously the biggest looming change why we feel that business is going to be busier in 2021 is because of these imminent tax changes that are coming.
Yeah, so taxes are going down?
Yeah. Quite the opposite, Kevin.
Okay. So, we have read and read and read all we can about this, and we are not going to we're going to document and source all the data. We're going to walk you through. But if what's projected on the tax scene actually comes to fruition, it will cause a material decrease in the net take home for each and every one of our clients.
Mm-hmm.
Let's just take a look at a quick example. Okay, let me orient you to this chart here. On the left-hand side, we're looking at two tax classifications: the maximum ordinary income tax rate, and below that, the maximum long-term capital gains rates. This is where all of our clients live, and I'm sure most, if not all of you listening out there live as well. Currently, we're in 2021, and the max ordinary income tax rate is 37%, and long-term capital gains is at 20%. What's expected from the taxfoundation.org, from Joe Biden's tax plan, is that to see ordinary income tax rate go up by 2.6% to 39.6%, and see the benefit of long-term capital gains erased. The long-term capital gains rate will go from 20 to 39.6, which is the same as the proposed ordinary income tax rate at the maximum level. So long-term capital gains almost double.
Right.
And all of a sudden, this allocation of the purchase price that we work so hard to negotiate on behalf of our clients and negotiate with the buyers becomes a little bit of a non-factor if we've got ordinary income tax and long-term capital gains pegged at the same number.
Correct.
Okay, let's see what all this means, though. Okay, so let's look at a transaction with $3 million of EBITDA, trading at a modest 7 times multiple.
Sure.
That's going to be a $21 million enterprise value. And through your hard negotiations, Ryan, you were able to achieve an allocation of the purchase price of 10% allocated to fixed assets and 90% allocated to goodwill or intangible assets.
Yeah, that's not an uncommon allocation on our deals. The buy side tends to, this is less material to them, this allocation, but it's extremely material to our client. So with some massaging and things of that nature, we're able to get this in favor of our clients on a very, very regular basis, if not, every time.
Yeah, when you're, and I have worked in the doctor-to-doctor transaction world before. There's a lot more sensitivity when the doctor is the buyer, when an individual person is the buyer. In our world, we're able to really negotiate this favorably for our client. So back to the example, we're at a blended effective federal tax rate of 21.7%. And if we take the proceeds of $21 million, remove from that the federal taxes of $4.5 million, in this example, on a deal that traded today, let's say, the effective net benefit would be $16.4 million. Now, there's an expectation that'll change in 2022. If, in fact, the tax rates do go up to 39.6 for both long-term capital gains and ordinary income, there's a material increase in the federal tax in the effective tax rate. We go from 21.7% up to 39.6. Again, allocation is the same, 10% to fixed assets, 90% to goodwill, but because the tax rates are the same, it frankly just doesn't matter to move the needle 1 inch.
Right.
So the same proceeds of $21 million, you're now paying taxes of $8.3 million on that same enterprise value for a net benefit to our client here of $12.6 million. So simply through a tax change, there has been a loss of net benefit to the client of close to $3.8 million. Business is the same, continues to perform the same way, multiple didn't change. All that changed is our tax rates here.
Yeah, it's certainly something to be cognizant of if for anybody out there listening that was 2 years out or several years out from doing a deal. Certainly worth a phone call to us to talk through what that could mean for you and what your business looks like today.
Yeah, I mean, no one's got a. I mean, look, we've all got a crystal ball, but no one's crystal ball is exact. It's perfectly clear.
Correct.
So we've thought about this analysis and said, well, if I'm 2 years away, 3 years away, should I sell now or should I wait? And the answer can be kind of solved through math. So we took a stab at seeing what it would take for you to get the same net benefit you would enjoy in 2021 with the effective tax rates that are expected in 2022. And really there are 2 ways to skin this cat. One is that your EBITDA is the same and multiples go up a lot. Here we show the multiple go from on that $3 million of EBITDA to 9 times from 7. And again, I'm working off the 1, 2, 3, 4th column here to get you to $27.3 million of EBITDA. This is a reach, team. I mean, that's could it happen? Yes, we've traded deals at $2.5 million of EBITDA for north of 10 times. It can happen, but it's by far not the norm at all. But if you were able to achieve this and knew with a high degree of certainty that you could, and you didn't expect your business to grow in the years to come, you can still get the net benefit of $16.4 million after tax.
With a substantial increase in EBITDA. Multiple.
Yeah. So it's a lot of ifs, right?
Yeah.
Then the other thing you can look at is it's EBITDA driven. So how much additional EBITDA would I need to put on the board, holding the multiple constant, to get to that $16.4 million of net proceeds.
Right.
Well, I got to add $890,000 of EBITDA.
Yeah.
And
Almost 30% growth.
Right. So you need 30% growth, and we're assuming you're not adding any additional debt to get there. Because
Sure.
if you got to go out and buy a practice and add debt to your balance sheet as well, keep in mind you got to pay off the debt before you take any proceeds.
Got it.
This becomes a little bit of a tenuous journey. So when we've racked up this math at our shop, it feels like if you're thinking about selling in the next 2 to 3 years, the time to act is now. I don't know the likelihood of this. The closer we get to, well, look, we've got the inauguration this week, and then the clock starts ticking in my mind.
Absolutely. Yeah, and we hope we're wrong. We hope capital gains tax stays where it is for as long as possible, but it's a pretty short bulleted list of priorities for this administration from a tax perspective, and it's at the top.
Yeah, it is. We've had a lot of conversations with attorneys and CPAs asking, do you think that there's any chance that Biden coming into office would do something retroactive to 2021, to the beginning of 2021? I feel like that's a political powder keg to ignite that's really unnecessary. There's plenty more for him and his administration to work on and work through before really getting to the tax issues that we just discussed.
Yeah, I agree. I think that would be just unnecessary and quite frankly not in the spirit of what they're trying to accomplish.
Yeah, I agree. All right, so if to reiterate and kind of, again, put a bow on this, if you're thinking about selling the next 2 years, you probably want to act now. You can always contact us for a complimentary evaluation of your business or your group. We regularly do TUSK vals for people who are curious about what their business could trade for. And what do you think, Ryan? 9 times out of 10, their CPA's gotten their EBITDA calculation wrong?
Oh yeah, 9.5.
Yeah, we go ahead and do all the work. We do that complimentary each and every time because we want you armed with this information to do what's best for you and your family in light of what could be coming down the pike with respect to tax changes in 2022. The other nice thing about this analysis is if we can get the same store economics, we can give you some tips on how to window dress your business for a sale. And again, are more than willing to do that on a complimentary basis. Ryan, you have done so many of these in the last 12 months. Anything you want to add to the TUSK val process and the information that we share with those who choose to engage us in this way?
Yeah, we take a lot of pride in educating folks to make sure that they're in alignment with us, that we are the best fit for them and are going to add the most value to their situation with respect to getting a deal done. So we take a lot of time to make sure that you all understand all of the components of that valuation, all of the components of a proposed deal structure, perhaps even version A, B, and C, to get a feel for what resonates with you, what's important to you, where you're at in your journey, because our clients are working 5+ years in these businesses more than likely. There might be one partner or 2 partners that want to stick around for 2 or 3 years, but the majority of our clients are sticking around for 5 years or more. So understanding the deal structures, what is available out in the marketplace is absolutely critical. And I think if you talk to any of our clients, that education process on the front end prepared them to make sure that they knew what they were going into, and that we were confident that we could get them a deal that would exceed their expectations.
Yeah, it's critical, right? We work hundreds of hours on each one of these deals, so we want to make sure that we can meet or beat expectations each and every time.
Yep.
Okay, well, let's end on. I've got 2 slides, and then I know everybody's got a busy evening, get back to family and friends, and well, there's no more football tonight, so so you got the night off on football. That's good. All right, let me advance here. A lot of you have seen this slide before. For those of you who have not, let me orient you. Across the top is EBITDA in millions of dollars, starting with 1 million, 2 million, 3 million, all the way out to 20 plus million. Below that are the multiples that we have seen deals trade at based on the size of the business's EBITDA. So for example, if you're looking at a $3 million EBITDA DSO or group practice, we've seen that a $3 million EBITDA business trade anywhere between 5 to 10 times. It's a wide berth, right? You could probably drive a couple of trucks through that. And what we get asked a lot is, well, how do I get on the high end of that range? Well, what you don't do is wait for somebody to call you and offer you that number.
Sure.
Unsolicited offers aren't going to land you there. Your EBITDA is interesting, but it's the beginning of a conversation. We spend a lot of time, an inordinate amount of time, getting to know you, your story, how you got to where you are, and where you're going. I like to say that your TTM EBITDA is what gets the buyer's attention, but it's your pro forma and forecasted future EBITDA is what they're buying. They don't get access to your trailing 12. They're only buying the future. So cementing that story and knowing those answers are critical to get you to that higher valuation range. And just to share with you a little bit more about how we think about that, we use a framework for each one of our clients to help us really dissect the business and then help teach the buyers about where the opportunity lives. After going through this year with COVID and seeing what we saw and how the buyers reacted and which buyers not only survived but thrived during COVID and post-COVID, I mean, I feel armed with all this information that we can use judiciously to really help build great partnerships on a go-forward basis with our clients.
Yeah, I'm really excited about this year to come and looking forward to working with those of you out here on this call.
Thanks to everybody who joined us this evening and gave up an hour of your time. Thank you for the questions that you've logged in. We will certainly reach out to you individually and follow up. Our contact information is on the screen now. You can reach out to either or both of us to set up a time. You can visit our website, www.tusk-partners.com, to book a call, to see the testimonials of clients that we've worked with in the past. Look, we're here to help, and we want to make sure that you find not just the highest value for your business, but the best partner who's going to help you grow and allow you to enjoy all the upside that you so richly deserve throughout the relationship. So this is Kevin and Ryan. Thank you again. Have a lovely night.